All right, let's dive right in. Today, we are putting one of the market's most talked about stocks right under the microscope, CrowdStrike. It's a cybersecurity beast that everybody seems to love, but wow, has its stock price been on a wild ride. So, is this a brilliant buy, or is it a dangerously expensive bet? Let's dig in and figure it out.
Okay, so as of early April 2026, this is our starting point. A single share of CrowdStrike costs you just under $394. That number, right there, is our ground zero for this whole investigation.
But here's where it gets really interesting. That price doesn't exist in a vacuum. The stock hit a mind-boggling $557 late last year, but it's come down a whole lot since then. It's even dropped about 8% in just the last month. You know, that's the kind of volatility that makes people pretty nervous, and it raises a huge question.
And that, right there, is the big puzzle we're here to solve. Is this an absolutely phenomenal business that you should be excited to own? Or is the stock itself just way too pricey, way too risky at this level? Or, and this is the tricky part, could it be both at the exact same time?
So, to get to the bottom of this, we've got a clear plan. First, we'll look at the business itself. Then, we're going to apply the famous Peter Lynch investment test. We'll see what he'd love, what would make him worry, then we'll see if we need to adapt his rules for today's market, and finally, we'll land on a verdict.
First things first, before we can even talk about the stock, we have to understand the company. What is CrowdStrike? What makes them kick? And the business? Well, to put it simply, it's exceptional. I mean, this is an undisputed leader in cybersecurity. They just blew past $5.25 billion in annual recurring revenue. They're generating a record $1.24 billion in free cash flow. And get this, their gross margins are nearly 80%. That is just incredible efficiency. And on top of all that, their customers absolutely love them. Gartner even named them a customer's choice. Okay, so we've established it's a fantastic company, no doubt. But does that make it a fantastic investment right now? To answer that, we're going to borrow the playbook from one of the all-time greats, Peter Lynch. His whole approach was about common sense and really finding great growth at a price that actually makes sense.
And this quote, this is the key to his entire philosophy. He said, the price-to-earnings ratio, which is basically what you pay for a company's profits, should be about the same as its growth rate. It's such a simple, beautiful rule of thumb for figuring out if something is fairly priced. Keep this idea locked in your head, because it's about to become really, really important.
All right, let's put on our Peter Lynch glasses for a second and look at CrowdStrike. Lynch had these categories for stocks, and you know what? CrowdStrike fits perfectly into what he called a fast grower. So let's see what would get him all excited about this company.
First, the story. Lynch loved a simple, powerful story you could understand. And CrowdStrike has it. Their Falcon platform is the gold standard. The growth? It's right in his 20 to 25% sweet spot. He'd also really like the AI angle. It shows they're not sitting still, they're innovating. But maybe most of all, he would absolutely love this balance sheet. Over $5 billion in cash and almost no debt? That's a fortress. That is a company that can handle pretty much anything thrown at it. So the business quality gets a huge, enthusiastic checkmark. But remember Lynch's golden rule? This is where our story takes a sharp turn, because there is one number, one metric that would make him slam on the brakes. And to find that number, we have to calculate something called the PEG ratio. It sounds technical, but it's just a way of putting his rule into a number. You take the PE ratio and you just divide it by the earnings growth rate. A PEG of 1 is considered fair. Anything under 1 is a potential bargain, and anything over 1 is starting to get expensive. Okay, let's do the math for CrowdStrike. We take the stock price, divided by the earnings per share they're forecasting, and we get a forward PE ratio of about 81, which is pretty high. Now, the company says they expect earnings to grow around 29%. So we take 81, we divide it by 29, and we get
2.8. Yeah. According to the classic Peter Lynch formula, where a PEG ratio of 1.0 is fair value, CrowdStrike is trading at almost 3 times what he would consider a reasonable price. This, my friends, is the big, flashing red flag.
And this matrix just lays out the conflict perfectly. Look at this. You see all these green check marks for the business itself, fantastic growth, super strong financials, great profitability. But that very first line, the valuation, gets a giant red X. It's a textbook case of a phenomenal business trading at a very, very challenging price. But wait, is that the end of the story? Maybe not. You have to remember, Lynch came up with these rules when he was looking at retailers and industrial companies. These modern, high-margin software-as-a-service companies, they're just a different kind of animal. So it makes you wonder, should we adapt the rulebook a little bit?
And what's so great is that Lynch himself gave us the answer. Later in his career, he admitted that for the absolute best of the best, the most dominant companies, he called them stalwarts, he'd be willing to bend his own rule. He'd pay a premium, maybe a peg of 1.5 or even 2.0. And look, if any company today qualifies as a stalwart in its industry, it has to be CrowdStrike.
So what would that actually look like in dollars and cents? Well, this chart puts it all into perspective. You've got the current price way up there near $400, a more flexible, reasonable Lynch price, using that peg of 2.0, would be all the way down at $280. And a true classic Lynch bargain, that's way, way down at $140. You can see just how massive the gap is between where the stock is today and where even a more modern Lynch model would say is a good entry point. So, after running the numbers and thinking through all the nuances, where do we actually land? What is the final verdict on CrowdStrike stock today? You know, our whole Peter Lynch investigation leads to one single unmistakable conclusion. CrowdStrike is a world-class, A-plus business, but it is trading at a price that is definitely not a bargain. Simply put, you are paying a very heavy premium for that quality. It really just boils down to this simple trade-off. On one hand, the opportunity is to own a dominant company that's absolutely essential to our digital future. On the other hand, the risk is that you are paying a price that basically assumes everything is going to go right, forever. There is almost no room for error baked into that stock price.
And this chart really shows you the battlefield of opinions. You've got the Super Bulls on Wall Street who see the stock going to $500, maybe even $600. Then you have our more value-focused Lynch analysis suggesting a much better entry point is somewhere down near $280. And right now, the market has the stock priced right in the middle of that big tug-of-war.
Which leaves us with one last and pretty provocative question, using Peter Lynch's own colorful language. Knowing that you're looking at a fantastic company, but at a really high price, is the right strategy to just be patient and wait for the market to have one of its classic freakouts to, as he would say, puke and give you a much, much better price? Well, that is the billion-dollar question, isn't it?